Investment Advisory Committee this January 13th of 2022. On our agenda, we have a call to order. So with that, if we could do the roll call, please. That'd be you.
Oh, okay. Commissioner John Hammercheck?
Present.
Commissioner Ron Young? Present. And Treasurer Michael Zurin? Present.
Very good. Thank you, sir. Our first order of business is to do the election of officers. So I believe we have a position for chair and for secretary.
I would like to nominate Commissioner John Hammercheck for chair of the committee.
Thank you, sir. Thank you. And discussion? None being heard. Roll call, please.
Commissioner John Hammercheck?
Yes.
Commissioner Ron Young?
Yes.
And Treasurer Michael Zurin, yes.
Thank you, sir. And I would be honored to nominate Treasurer Michael Zern for secretary of the investment board. Do I have a second?
Second.
Thank you, sir. Discussion? None being heard. Roll call, please.
Commissioner John Hammercheck?
Yes.
Commissioner Ron Young?
Yes.
And Treasurer Michael Zurin, yes.
Very good. Okay, moving on to the approval of the meeting minutes of the October 28th, 2021 meeting. Do we have a motion to approve same, waiving the reading thereof?
So.
Second.
Discussion? None being heard. Roll call, please.
Commissioner Ron Young?
Yes.
Commissioner John Hammercheck?
Yes.
And Treasurer Zurin, yes.
Very good. This brings us to our old business portion of the meeting. Do we have any old business? None being heard. Moving on to the new business, we have our investment review. So batter up. Thank you as always.
Yes, thank you very much, and happy 2022.
Well, let's hope it'll be a happy
Exactly.
From your lips to God's ears, right?
Yes, and we're hopeful that 2022 is, not like 2021, but certainly it has been starting out with a bang from our perspective. A lot of movements within the marketplace that clearly will have, we believe, a positive impact for the county as we invest the county's funds. So just looking at some of the points that are impacting, of course, interest rates, when we look at on page 3, the Federal Reserve dot plot, which they issued an update to that in December as part of their quarterly meeting. And each dot, of course, represents each member of the committee's forecast on where that overnight interest rate should be. When we look at 2022 and we look at the dots, we can see that clearly, the Fed is signaling to the market that we could expect three rate hikes in 2022. So this is definitely more rate hikes than what were previously communicated in September. And really even more rate hikes than what they were speaking about in public throughout even October and into early November. So clearly there has been a shift in the pace of projected rate hikes coming out of the Fed, and as we will see on the next slide, that's in line with what the market is somewhat expecting. When we look out at 2023 and 2024, of course, there's a dispersion amongst the participants' forecasts, and so clearly there remains some uncertainty as it relates to how far this rising interest rate environment will continue as we look in those out years. So I mentioned, the Fed's forecast is more so in line with what the market is expecting, and what this chart does is it compares the Fed's, that dot plot number, the median of where the Fed is projecting that the overnight rate will be, compared to what the market is pricing in by looking at basically the Fed funds futures market. And so when we look at the lighter blue lines, that's the Fed, and the darker blue lines is the market. But the market has, at least had prior, pretty much not felt that the Fed would start to move until they completed their tapering of their asset purchases, the quantitative easing, not purchasing additional securities in the marketplace. But if we look at where we're at here today, the Fed has ramped up that pace and really has started to talk about also moving very quickly into shrinking their balance sheet. And of course, that would be viewed within the marketplace as an additional tightening of monetary policy. So that being said, when we prepared this, the market really wasn't expecting that the Fed would do anything until starting later in this year, but that has since been moved up to expectations that we will start to see our first rate hike actually in March. So the market is now pricing that in. But when we look out longer term, the market is feeling that, the Fed won't be able to get rates fully back to normal, and of course normal is that 2.5% range. But again, as market conditions change, the market's forecast also changes as well. But clearly, the market is expressing some concern. Number one, the length of time that the COVID is continuing to impact not only the U.S. market, but the global markets, or global economies, I would say. And then additionally, the fact that inflation, of course, as we know, which has been on a tear of late, at what point will that really perhaps start to abate, if at all? So when we think in terms of the Fed's mandates, full employment being one, and we look at the unemployment rate and look at some other employment measures, as we can see on this chart, the December unemployment rate has dropped now to 3.9%. In the Fed's view, that is truly considered meeting full employment. So the Fed can clearly state that they've met their mandate. And the fact that the unemployment rate did drop to 3.9%, we believe, of course, has contributed to the Fed being able to now really start to guide the market as it relates to faster rate hikes as well as shrinking the balance sheet. Now, of course, 3.9% unemployment rate is a national rate, and the unemployment rates across states do vary. The map that we had Ohio at 5.1. The November rate for Ohio was 4.8, and of course Lake County is in a much better spot at 2.9%. Which are very fortunate to be there, but clearly, we still do have people who have not returned to work. There's still 3.6 million jobs that have not been filled compared to pre-COVID. But as we're seeing, some organizations are starting to shift, their operations to accommodate or accept the fact that perhaps some of those workers may never come back. So a continuation of automation is positioning, particularly in the manufacturing world, and we're even seeing that in the some service industries whereby they may not necessarily need as many employees.
Before we move off that, so on that 3.9%, does that also, I'm assuming, not count people who've just stopped being active participants in the workforce?
Correct. That is correct, yes.
So it's not necessarily a true reflection of potential workers available, it's just people who are actively looking, that's
yes.
all of that.
That is correct. And that's one of the big challenges that we see, of course, also in looking at the data is, we have one measure that shows good story, we have another measure that you look at and it's a head scratcher. Why aren't people back to work? And the other factor too is that's reflected in that labor participation rate, which has been kind of stuck at just shy of 62%.
Gotcha.
Yeah.
Another example of government math that works.
Yes.
Excuse me, what is the normal labor participation rate? 62% now, what is it? In a good economy, what is it?
In a good economy, and this is, just to put it in reference compared to pre-pandemic, it's upwards of 64%. So we don't think, you would think it would be more like 80, but right, it's still a very low percent. But when we think in terms of the number of people in the U.S., every 1% is still a very sizable number.
What would that be approximately?
Oh, good question.
Oh, I thought you had the percentage right on the tip of your tongue.
That I don't. I can't say that. I know employment levels were previously at 150 million, so pre-pandemic. So even if we took 1%, and that of course, if that's 65% of people, employed, inferring, that would certainly, quick math, not always the best, but would translate into perhaps, around, 250 million people or so in the labor that could potentially, we would consider be able to work. And, 2% of that, is, what would be 5 million? Yeah, workers. Yeah.
250 million?
Well, I'm just trying to interpolate mentally. 150 million, if that's 62%, what would be 100%?
So
Yeah.
the labor participation rate, that is based on people who are 18 and over?
Yes.
Is that- Okay.
Mhm. Yes, that's a broader measure. Yeah, good question. Yes. Of course, inflation on your next topic here, has been certainly on a tear. As I've said, we've gone from the perception being that inflation is transitory, just a function of increased demand for goods as a result of stimulus dollars in the hands of individuals and businesses and governments, kind of a one-time shot of money in the marketplace,